always keep your set of rules with you in a simple notebook when you're investing. What you say you've been investing without any specific buy or sell rules, what results has that produced for you over the last 5 or 10 years? So I think this kind of gets to the root of why rules are so important. If you're not operating with any rules, you're operating randomly and without consistent inputs, you're not able to trust the outputs and tweak things and, actually improve as a trader because you don't have that baseline consistency. So why do you need trading rules? If your rules aren't written down and detailed, they don't necessarily count, especially earlier in your trading career. More advanced traders who have been doing this for a decade, Ross, he operates a little bit more on feel and intuition, but that's because he's earned the right to do that and he's internalized all the rules that we're talking about. Basically, you want to list out and define each setup and edge and entry tactic that you use, whether that's base breakouts, pullbacks, gappers, whatever you personally like to trade. You want to include annotated chart examples of valid setups to reinforce that pattern recognition, and that can be a resource for you. All the top traders talk about studying history, studying the past, studying previous market leaders, building a database of setups that they can refer back to, or just, use them to train your eye to improve your pattern recognition. Getting into the next section, risk management. Basically, you want to define how you'll set stop losses for each setup, set position sizes as well, set maximum total exposure and maximum position size numbers as well, and how it changes based on market conditions. Write rules for when and if you'll use margin and to what degree. What are your sell rules? Are you going to sell primarily into strength? Are you going to sell primarily into weakness? Outline how you're going to manage winning trades, raise stops, trail, scale out, clarify, how you'll let a stock work and trend for you, and then when you'll ultimately exit based on a violation and rules to sell to weakness. So getting into post analysis and journaling, again, you kind of want to define in your rules how often you're going to do that, and most important thing is to be consistent. If you're not able to do it daily or weekly, just set a cadence that you'll be able to stick to. So getting into contingency planning, this is kind of the last section of your rules. This is a little bit more, any rules that you haven't put in before is kind of more general or maybe more specific, you can put in here. Plan for worst case scenarios, massive gap downs, tech issues, account lockouts, how you'll have backup systems, basically have a panic playbook, I put in quotes here, for, key things that might happen and will happen over the course of your career, but that you definitely want to plan for. Written rules, again, they're your business plan, they're your contract with yourself that you're serious about trading. They're required if you want to treat this like a business and not just like a hobby. Hobbies lose us money, businesses make us money over time, and we want to be making money while we're trading. And this is really key here. Your rules are a living document. They're going to refine them as you grow, as your style shifts, as you gain a setup, lose a setup. All right, so let's go ahead and get started, everybody. Move this down here. Welcome to the next Trader's Handbook webinar. We're super excited for this one. We're getting down to the home stretch here, but there's still a lot to cover. And today is kind of a little bit of a look back in terms of talking about the key concepts that we've already talked about. Market cycles, screening routines, risk management, entry tactics, setups, edges, all of that. And how do you put that into a cohesive trading system and write your trading rules? So here's kind of where we're at currently. Writing trading rules right here. Next weekend, we're going to have a double header, trading analytics and analyzing trades, getting into post analysis. And then later on, we'll get into kind of future growth. How do you improve as a trader by building model books, finding new edges, doing trading studies. And then we're pretty close to the launch webinar of the book, which we'll talk about, what's in the book, what's included, what are the bonuses, and it's exciting to actually get it into your guys' hands. So again, all these webinars tie into the concepts of the handbook. If you're enjoying these webinars, you're going to love the book. And, it's one, complete package. They complement each other. So if you enjoy the webinars, again, make sure you pick up your copy of the Trader's Handbook before May 27th so you can get it on that day. Here's a quick reminder to, if you haven't already, to join the Trader's Handbook list. I'll be sending out a growth stock trading rule set today to everybody who's on the list. So if you've already kind of received these emails, you're probably on the list already. But if you're not, go ahead and scan here and join, and I'll make sure to send that your way today. We've already sent a bunch of educational articles that, again, complement the webinars and complement the book as well. All right. And here's just the link to order the Trader's Handbook to pick up your copy if you haven't already. Let me know in the chat right now, have you picked up your Trader's Handbook? We saw a big influx of people over the last week, so that's great to see. But here's the link if you haven't already ordered yours and grab your copy. And you definitely want to do it pretty soon to make sure you get it on that launch day. And here's a nice testimonial. We sent it out to a few folks before to get their feedback. This is a review from Deepak Upal, top performer in the US Investing Championship. You've probably seen him be interviewed on the TraderLion podcast a few times. He also presented at last year's conference. Fantastic trader, and he had some very nice words to say about the handbook, just highlighting ones. Drawing from the strategies and principles used by some of the world's top traders, this book distills complex concepts into actionable steps that traders of all levels can understand and implement. He talks a little bit about the model book chapter and really liking that, and I think this is the big one. This is our exact goal with the handbook, is to lay out the fundamentals, lay out the key concept that we've distilled, that the top traders we talked to have distilled, to save people time and costly mistakes. That's the negative about this business, is when you're going in and are maybe a little bit inexperienced, you're going to make mistakes, and that's part of the learning process. But if we can prevent and help you out and try to limit those mistakes as much as possible, that's our goal with the Trader's Handbook, and I think for sure we've accomplished that. And then very exciting and another kind of incentive and to sweeten the deal to order your handbook this weekend. If you pre-order by this weekend, you'll actually also receive a $100 TraderLion gift card. We'll send that by email once you go ahead and pre-order and submit your receipt. And I'll talk about how to do that in just a minute. But this is a pretty big deal, pretty big incentive. And if you're already planning on getting a masterclass, this is perfect. And basically, again, you'll get a $100 TraderLion gift card as a nice bonus if you pre-order by this weekend only. This offer will be going away at the start of next week. So here's a QR code to order again. And I just want to emphasize again, this is more than a book. Again, we're working really hard to make this the best introductory educational experience that anybody can start with. So in addition to the Trader's Handbook resource as well, you're getting access when you order the book to the Trader's Handbook educational course. This packages all the webinars that we've recorded through the series, as well as bonus educational articles and guides, the companion workbook, and then a bunch of excellent model books, including the weekly charts model book, the base breakouts model book, the sell rules model book, the market cycles model book, and also we'll be doing an exclusive Q&A for only people who have pre-ordered the book. And in addition, just announced this past week, we'll be doing some bonus webinars only for people who have pre-ordered. And the first one is tomorrow on trading breakouts, getting into some advanced strategies. So here is a little bit more information about the webinar tomorrow. Again, it'll be at 11 a.m. Eastern, only for people who have pre-ordered the book. The link will be sent out via email to all those folks who have submitted their proof after today's webinar. And you can go ahead and scan here to submit your receipt. You can download it from Amazon and just make sure that the order number is visible. But this is the link to the form. And also, if you look at the description of this YouTube live stream, we've also got the link that says submit your receipt here. And that's how you get access to this webinar. So again, pre-order your book and then make sure you submit your receipt and you'll get access to, again, all these bonuses here, as well as tomorrow, the Trading Breakouts webinar, and then later in the week, the Trading Gappers webinar as well, and then later after that, the Trading Pullbacks webinar. So a lot of nice incentives to go ahead and get your book pre-ordered. And again, our goal is to make this the best educational experience you can have. And, this is how you unlock those bonuses. All right. So let's get into today's webinar. Welcome everybody once again to this educational Trader's Handbook webinar. Today we'll be focusing on trading rules, super performance rules, how to set them up, different sections you should include, and how to actually go about creating your rule set. So this is going along with chapter 10 from the Trader's Handbook, and this is about identifying and actually enumerating your system so you can perform in the markets. Here is a quote from William O'Neill that I want to start with. This is from How to Make Money in Stocks over my left-hand shoulder. Always keep your set of rules with you in a simple notebook when you're investing. What? You say you've been investing without any specific buy or sell rules. What results has that produced for you over the last 5 or 10 years? So I think this kind of gets to the root of why rules are so important. If you're not operating with any rules, you're operating randomly. We've talked about this quite a bit during previous webinars, and without consistent inputs, you're not able to trust the outputs and tweak things and, actually improve as a trader because you don't have that baseline consistency. So rules help us with enumerating our system, keeping us consistent as possible with a discretionary system, and allow us to improve over time by doing post analysis, tweaking a rule here and there, adopting a new setup, a new sell rule, and just improving, over time, instead of just kind of randomly floundering and acting based on emotion, acting based on what you feel in the moment. We have to have rules. They are our, trading plan. They're our business plan to operate with the markets. I see a question here from Elaine. What if I bought from Barnes & Noble? No problem. Just submit that receipt as well to that same form. So wherever you purchased the Trader's Handbook, just go ahead and upload that, showing that proof, and you'll be in. All right. So I wanted to start today's webinar actually with a little bit of an analogy, and bear with me for a little bit. But let's say that there's two folks, Tom and Jack, who are decided to start a smoothie business. Maybe they're in the same town, and they'll be they'll be competition to each other. Tom on the left hand side, he worked at a juice bar for 12 months before this. He's got some experience. He read about the most successful smoothie fast food companies, studied them, what made them successful, what business models did they have. He polled his local area about what type of smoothies they would love to consume. And before opening his business, he planned out his initial menu, planned out pricing, location based on testing, and decided to set up a location next to downtown, as well as a bustling public park with a lot of kids' soccer games on the weekends to get that clientele. And then in addition, he had a soft opening where smoothies are buy one, your friend gets one free, to have that special offer to get that initial boost in clientele, that word of mouth going. And in addition to that, he planned a reward system where your fifth smoothie is free. And then in addition to that, he also planned a cure system where customers could give feedback on what he's doing well, what he's doing not well, and request flavors, toppings, what have you, whatever makes a smoothie great. He has that built-in feedback system that's easily accessible right where people are, consuming their smoothies. On the flip side here, we have Jack. Now, Jack was told by his friends and family that he has a natural knack for business. In college, he made some smoothies for himself that his roommate said he liked. He pre-bought in bulk tropical flavors because he thinks that they'll be the most popular just based on intuition. And he picked his location based on the cheapest space available in the town, which is off the main street, just in a back alley. And for his marketing plan, he decided that paid ads in the newspaper will be his key marketing approach. So taking a step back and looking at both Tom and Jack, let me know in the chat right now, who do you think will be the most successful in 1 year, and why? Let's see. Let me pause here. And I'll get to how this corresponds to trading rules in just a minute. All right, we got Tom here. One vote for Dom. RC says Jack will be out of the biz in 6 months, less than 6 months. Love Tom. Somebody says Richard Moglen. I'm not in here, but yeah, I vote for Tom as well. All right, we got a lot of Toms. Perfect, guys. So that's exactly what we're talking about here with, creating a business plan. And what differentiates Tom from Jack? A clear business plan, and as a part of that business plan, he also built in a feedback loop with the QR code system where people can give feedback, request flavors, basically request ways that he can improve his business and listen to his customers. So how does this correspond to trading rules? Well, if you're going into the market just based on feel, based on what you think, has worked in the past, what you think, will continue to work, people have told you have a knack for the markets, you're much more like Jack than like Tom. And over time, you probably won't be successful because you haven't enumerated a system for yourself. You're going based on feel. You're going based on emotion, what you think should work, instead of listening to the market and following a consistent set of rules. Whereas Tom is a trader who has studied the markets, studied top traders, studies what has been successful in the past. He's enumerated his buy, sell rules. He's enumerated his setups, all of that. And he's going into the markets with a clear plan and a clear way to also improve through post-analysis here. So hopefully that analogy wasn't too long-winded, but I just want to kind of, trading, I think, it is nebulous because anybody can join. It doesn't take much to open an account and get going, but I really want to emphasize the importance of having a plan, having a business plan, because really when you are entering the market and with a goal to grow your accounts, you are starting a business. And with that comes the seriousness. You have to, treat this with respect. You have to put in the work and make sure that you have a proper business plan before you actually enter trades and, continue to have that improvement over time. So this is just a quick analogy to show, how this compares to starting a business. And, the importance of having a trading plan in the first place. So here's the agenda of today. First, we'll discuss a little bit about why are trading rules essential. We'll get into market analysis, stock selection, and routines. Edges, setups, entry tactics. We'll cover those from a high level. Risk management and position sizing, sell rules and position management. These are all key sections that your trading plan should have. And we'll tie it back into previous webinars and what we've talked about in those. And definitely for each of these sections, say you realize you really need to work on your setups, entry tactics, rules. That means that you should go back to that webinar, rewatch it, take notes, and think about how that applies to what you're doing, the setups that you like to trade, the entry tactics you like to use, and then you can go ahead and enumerate those rules. So that's kind of the goal of today, is to provide the overarching structure to create your trading rule set. And then you want to fill in the details yourself this weekend. That's my kind of homework assignment for all you guys. So you've got an updated rule set to trade with. So that kind of ties in well to this quick poll here. Answer in the chat. Do you have trading rules? Answer A if you say yes, updated in the last 6 months. B, yes, but they need updating. Maybe you made them a year ago, 2 years ago, but they're not up to date with how you actually trade right now. C, you have some rules, but it's not organized in a nice document. Or D, I don't have trading rules yet. So we'll see what you guys have. I see some C's. I see some B's. I think a lot of people will be B's and C's. My guess would be. All right. So lots of C's. Perfect. So yeah, today, we're really addressing the B's and C's because we'll be talking about the overarching structure, how to organize them, and then how to also go ahead and update them. I see RC is an A, perfect. Tom is an A, that's excellent. B's and C's, perfect. Excellent, guys. So yeah, if you're a B and C, this is the perfect webinar for you. And if you're a D, you have to watch this webinar. That's 100%. So let's get going. So why do you need trading rules? If your rules aren't written down and detailed, they don't necessarily count. So this is talking to the C's there previously, especially earlier in your trading career. More advanced traders who have been doing this for a decade, Ross, he operates a little bit more on feel and intuition, but that's because he's earned the right to do that. And he's internalized all the rules that we're talking about. Jared Tendler talks about moving the inchworm forward, where your A, B, and C game, just get more and more compressed over time as you gain more experience, as you gain more intuition. But if you're just starting out, your inchworm, your performance, your A, B, and C game are so spread out that you really need rules to help constrain them to keep your process consistent and keep your outputs consistent as well. And I think this is this should be the perfect impetus to write your first trading rule set or improve it if you haven't already. A clearly written rule set is the fastest path to consistent execution and improved performance. If you're a stage 2 trader, rewriting your trading rules or refining them is how you get to stage 3. Adding in a market cycle system to your trading rules, that's how you get to stage 3. Adding in improved sell rules, that's how you get to stage 3. Mastering a setup, diving deeper into that and codifying that into your trading rules, that's how you get to stage 3. So again, a clearly written rule set is the fastest path to consistent execution and improved performance. And I think this is key and something I want you to walk away with today. Your rules must be clear enough that another trader with similar trading knowledge could follow them as exactly as you do. So somebody else, if I'm showing my rules to Rye, he should be able to read my market cycle system and define it as I would on a chart of the QQQ, or similarly my buy or sell decisions. He should be able to figure that out based on my rule set. There shouldn't be enough gray area, vague enough that he wouldn't be able to interpret things as I've defined in my rules. I think this is key as well. Rules protect your capital and allow compounding over many market cycles. Again, the goal of this is to do it for decades. We don't want to just be a flash in the pan trader where we do really well in a great year, but then we give it all back because we don't have proper sell rules or proper market cycle system rules. And when we enter a bad correction, bad bear market, we give it all back and then some. And then also, your rule set should be tailored to your style, goals, time frame, and personality, and should be updated often. My rules aren't going to look exactly like Rye's. It's not going to look exactly like Ross's. We all have different, slightly different time frames, strategies. I might favor a certain setup over another one. So you really have to tailor these to how you trade, the setups you like to trade, how you like to manage risk. But the important thing is that you have to have one in the first place. And I'm going to give, again, we're sending out today to everybody on the list, everybody attending today's webinar, a sample trading rule set. That's perfect as a starting point, a foundation for position traders and swing traders, but you shouldn't just copy that, line by line and use that. Again, you should add your own tweaks, add your own personal improvements that tailors it to how you trade. And really the benefit is not just in copying somebody's trading rule set. I could copy Rye's trading rule set, and I wouldn't perform like him. Why? Because I don't have, my style isn't exactly like his. I don't interpret things exactly like he does. So you don't want to just say, all right, this person has this amazing rule. It works for him, but he's a position trader and I'm a swing trader, but I'm going to use his rule because it's worked for him and he's performed tremendously. You want to tailor your rules to how you trade and really internalize them. So that's really important, is when we send this trading rule set, the sample rule set, out to you guys, don't just copy it. Use that as a foundation, a template, but tweak it and improve it and make it yours. Right. Anything you want to add on why traders need trading rules? Maybe touch on, how it improves consistency, which is critical from going from stage 1 to stage 2 to stage 3.
Yeah. So everything we've learned with all the webinars that we've done so far, the 8 webinars, is concepts, and all those concepts need rules of engagement, be it the market cycle, when it works, when it doesn't, what position sizing you'll place when, right? That's a rule that you place. So the first 8 webinars were about concepts that we covered. And then this webinar is bringing together all the concepts that we've covered to now apply them in a business plan, right? So without consistency is about having a blueprint and then executing upon that blueprint, and rules allow you to, execute consistently, basically. So I've seen many traders in the conversations that we have and things of that nature where they know all the concepts, they know all the theories, they know all the systems, right? I know what can slim is, I know what I'm supposed to be, conceptually, and they're very good academically at knowing what the market does or what the market's about, right? But they fail to have a consistent set of, this is where I will engage and place positions while the market is in an uptrend. This is where I will be on the sidelines no matter what. And that's where rules come into play, right? And if you're running a business or you have a small business and things, there's a different word for that. You need a standard operating procedure for you to go in and execute a certain business objective. When it comes to trading, we're trying to do the same thing here with building a rule set, right? We're trying to stop ourselves from ourselves because we're very emotional with the way, if we even know that, hey, we're not supposed to be, let's say, buying below the 200-day recently. Yet many people go into that and step into that because they don't have a clear rule set. And when you don't have a clear rule set, you lack confidence. You don't really know what's about to happen in the markets. You're going to act random, right? And then you end up buying below the 200-day because you felt like it was a good opportunity. But then when that good opportunity gets hit by a 5% gap down the next day, then you go back to, hey, I should have followed my rules and things of that nature. So rules kind of take the concepts that we've learned in the first 8 webinars, and in the 9th one, it's all about, now formalizing it as a business plan that, hey, this is when I will get to, trade on the long side. This is when I will define and how I will define choppy markets. This is how I will go long and how I will position. And all those concepts will now need explicit rules as to, we could call them rules of engagement, as to when you will act, when you will take action, and when you will take decisive action or no action in the markets. And that's where rules come in.
Yep. And I liked what you said there about being emotional in the moment, because I think, again, if you ever had an instance where a stock meets your criteria, your rules, and it's pushing through the pivot and your rules say buy, but you don't act right away, or you feel unsure in the moment, that's basically a message to you that you need to revisit your process. You need to revisit your rules. You need to study more trade examples from the past so you build confidence in what you're doing. Clear rules and a clear system give you confidence in the moment, which allows us to execute better, manage risk better, all of that. So I think that's a really good thing that you said here. Again, when building your rule set, focus on clarity, specificity, and depth. Vague rules lead to vague results. Avoid generalities like buying an uptrend. Define exactly what criteria, defines an uptrend. Define exactly what criteria you'll use. Use specific technical criteria like QQQ is above a rising 21 EMA or daily 21 EMA in your rules. And here are some key sections that we'll get into throughout this webinar to help define your trading rule set for you. So here's a bad rule example. If the market is in a downtrend, I will trade smaller. Well, what does a downtrend mean? On what time frame? Are you looking at a weekly chart to define that? A daily chart? What moving average? How are you defining a downtrend? Then, on the flip side, what does smaller mean? By how much? How are you going to decide that? This is basically just not specific enough. A trader of a similar knowledge could not follow this rule exactly how maybe you understand it, but another trader couldn't follow it exactly. And by another trader not being able to follow it, that basically tells you that there's still some gray area in there. And that's what we want to erase with this webinar. So here's a good rule example instead. If the QQQ is below the daily 21 EMA, then I'll have my start position size from 15% to 7.5% until the QQQ reclaims the moving average or 3 out of 5 of my last trades were winners. Any trader with a similar knowledge to you would be able to follow that and mark up on the chart exactly where the QQQ crossed above or below the daily 21 EMA. So this is a much more specific and better rule set. And you don't need to go crazy. You don't need to define everything. Just think about if a friend who has read the same books, has been trading for the same amount of time, would they be able to understand your rule? If so, then it's a good rule. If not, you have to define it a little bit more. And again, that clarity will help you as well, because it will force you to think through exactly what you mean when you have that rule, exactly what you mean, and define how you're going to trade with your system there. So you have to be specific. That's a really key thing when writing your trading rules. So again, here are the rule sections. First, we're going to touch on market analysis, then stock selection and routines, edges, setups, and entry tactics, risk management and position sizing, sell rules and position management, post-analysis and journaling, contingency planning. We'll go through examples of rules for each of these different sections and kind of guide you through creating rules for these sections. But again, we want to be clear, what we're providing today is a template that you have to make your own. Maybe you'll separate out position sizing to its own section to really focus on it. Or maybe you'll add in a little bit more depth about doing trading studies and how often you'll do that. This is just a template, and you want to make it your own and add sections, delete sections as you feel is needed. So again, go ahead and make this your own. That's a key thing that we want to emphasize today in this webinar. All right. So getting into market analysis. Here's kind of from a high level, you want to define short, intermediate, and long-term trends using moving averages or other methodologies on major indexes or major index ETFs. And then we want to create rules for how those market conditions influence your exposure and aggression level. Then you can also to identify themes and use that to interpret the market, use ETFs or group performance to assess leading themes and sectors, and then maintain a leadership list and define how you'll update it based on price and volume action, and then basically adjust tactics based on different combinations of trend and leadership strength. For instance, if we're in a strong uptrend and the market leadership is doing well, you might have a rule to increase your position size, versus if the market is chopping above and below short-term moving averages and there's no clear market leadership, that would change how you do your position sizing, your overall aggression level, how much you're long, how much you're in short, how much you're in cash. So that's kind of what we're getting at here is your market analysis rules define the rest of your trading rule set and how you'll adapt that. Here's, a quick example about how you can define your market. Are we above or below the 21 EMA? You could use the market cycle count system, which we talked about extensively in the market cycle webinar. And if you haven't watched that, definitely do that. That's one of the most important ones from this whole series. And basically you want to define in your rules, are you hitting the gas pedal or brakes in this certain situation? Here's a rule example here that again is specific enough. The market trend is defined by the QQQ being above or below the daily 21 EMA. A change in trend is defined by 2 closes above or below the moving average. If we begin a downtrend, break below that moving average, treat winning positions on their own merit / rules, restrict new buys to standard position sizing and A setups. And if we sustain the downtrend for longer than 5 days, limit long exposure to 20% maximum, observe and look for relative strength and developing leadership stocks and themes as we go through the correction. And then if we begin a new uptrend, break above that moving average, build positions in 4 potential market leaders with 1% total open risk in the first few days. If we sustain the uptrend for longer than 5 days, trade as normal, and incorporate position trading feedback and continued positive action from the market and potential market leaders. So this is kind of an example of market analysis rules that define your overall activity in the market. Here's an example of how you can define groups and sectors and all that. You can use a deep view performance chart or something similar to identify what are the leadership themes. You'd want to express this in your rules. How do you incorporate this into your process? And then also leadership analysis, thinking about what setups themes are working, what stocks would a top trader own, William O'Neill own, a market wizard own, and incorporate this as well. If you, in your rules, define, look at the top 5 leaders, how are they performing? Incorporate that into your market analysis by say, if they're all breaking out, if they're all starting new trends, then you'll be more aggressive, versus if we've been trending for quite some time and they're breaking below moving averages, breaking below trend lines, all of that, then you'd limit your aggression and maybe tighten up stops, tighten up sell rules, all of that. So Rai, anything you want to add on market analysis rules that would be important for people to keep in mind as they're writing, their own market analysis rules?
Yeah, so the ones that I follow is when the market closes above the 21-day SMA, we start a positive market cycle. Now it doesn't really matter what moving average you use; it's all dependent on time frame. So you could use the 50-day, you could use the 200-day if you're an investor. You'll kind of accomplish the same results. It's all about, the rules are about consistency. It's not about what you're trying to do or what you aren't trying to do, or comparing one rule set to another. I always look at successful traders and what they're doing. Most of them use the 21 EMA. I use the 21 SMA because it works better, best for me. So don't get into this whole like that person's using it, I must use it. Just try to focus on what you do and what you can do in the markets to make things work best for you and your time frame. So my time frame is different than Richard's. Richard's is different than Ross's. Ross might be a more longer term type of trader. We're more swing trade types. So another one that I follow in terms of rules when it comes to market cycle is exposure. I think progressive exposure and knowing the first position that you place or the second position that you place, what percentage and how you will allocate that percentage. So progressive exposure goes hand in hand with position sizing, and you need to have those both tie into each other as to, okay, if I am going into a leadership stock that I've been tracking, that stock has shown relative strength, it has 2 edges, well, I'm going to allocate 17% of my portfolio as my first kind of cash to first position, right? And knowing that, okay, if there's multiple edges at play, I can go up to 17%. If there's 3 or more, I can go up to 25%. Will give you so much clarity, because then you have consistent input based on rules that you've set, and you'll get a consistent output, and then that consistent output goes back into that feedback loop that Richard spoke about with the Smoothie example. You'll have a business feedback, trading feedback loop, where you can then say, okay, 17% is too much. Maybe I'm too emotional, right? I need to tone it down from 17 to 12. Let's work at the 12% range in terms of position sizing, get more comfortable with that, and then gradually increase our way and get better at it. So that's with respect to market cycle, position sizing, progressive exposure. Another rule that I have generally when it comes to the market is if I have 2 or 3 losses in a row, I need to step back. That's an important one that traders need to pay attention to. Not every system will work every time and everywhere and every moment in the markets. There's times where things will work really, really well. There are times that things won't work no matter what you do, and it's the same system that you're following. That has nothing to do with you. It's more the mechanism of the market telling you that what you're doing is not working anymore, so you need to step aside, right? So knowing that your system is going to work in certain moments and not work in certain moments is actually one of the biggest things that you could do to get from stage 1 to 2 and 3 to 4 as a trader from a consistency and performance perspective. So if we take a look at what was happening with the tariff situation that we had, the market volatility, the drawdown of 20% from the highs, right? If you had a market cycle system that said that you're now in a negative market cycle and that cannot engage with the markets and cannot, I have to stay in cash, you avoid all of that volatility because that's a rule that you set for yourself. After April 22, if we pull up that chart on your guys' end, you'll see that the market cycle starts a positive cycle, right? We get a gap up in the markets, and then we get a next day, April 22 expectation breaker followed by it. Now, taking those two things into account, now you have rules of engagement to get you back in. And that's how you get your equity curve to have a high or low, right? And you avoid the volatility because you have rules in place to do that as well. So I guess what I'm trying to emphasize is, some of the things that I follow, which may be or may not be helping, but it shows that, having those consistent rules allows you to not only have consistent input and consistent output, but allows you to avoid volatile periods in the market that can really have significant drawdowns for you and your accounts over the years as well. So,
yeah, and one thing I want to emphasize here is, as you're thinking about each section of this, we talked about market analysis just now. Go back and watch the market cycle system webinar, because that's all that information that we shared in that webinar, defining a market cycle system, listening to trade feedback, progressive exposure. We showed them math through that. That's all your rules are going to incorporate that knowledge. So here we're talking from the very high level market analysis rules, how to actually create them. But then you want to go back and watch that relevant webinar to, put them in place and write your own. So for each of these stock selection, we did a whole webinar on it. So we won't get too into the specifics. We're really talking about how to write rules around stock selection. So getting into this now, I saw a question about this, defining what a potential market leader is. We talked about that at length in that webinar, but just to say it again, you want to define a high potential stock using price action, volume, RS, and fundamental growth numbers. It meets the CAN-SLIM framework. It meets the Tigers framework. You want to favor stocks from emerging themes or groups showing broad accumulation, build routines for screening, updating watch lists, and scanning setups, and then regularly review and improve this discovery process to tweak it based on outcomes. So maybe you realize, this screen doesn't work, or you can improve it in some way. Go ahead and do that and incorporate that into your rules. So just getting a little bit into how you might define a market leader and what you're looking for in your rules. You could say something like a high potential stock has shown to display a powerful price action and is set up in a repeatable pattern that provides the opportunity for an asymmetric risk to reward. Potential market leaders or leadership quality stocks are stocks that exhibit superior relative strength and price performance, are liquid, and have strong growth prospects. They should likely be part of a disruptive theme in the market and have the potential to change how we work, live, or play. And they should meet the Tigers framework and exhibit multiple edges. So all of these are ways that you can define in your rules what exactly you're looking for to find an NVIDIA, to find a PLTR, to find the Tesla when it's in favor. And here's, again, the Tigers framework that we talked about in the stock selection webinar. And again, if you want more info about how to identify and select stocks, watch that specific webinar, which will be linked in the overall playlist as well. So here's the Tigers framework. Again, theme, the stock is riding a strong growth theme like AI or something similar. Innovation, the company has a standout product, service, or element that separates it from its peers. Growth, the company is currently growing its earnings or sales rapidly or is projected to in upcoming quarters. Quarterly triple-digit growth year over year and acceleration are preferred, but over 40% is kind of the mark that we're looking for. But all that doesn't matter if it doesn't show up in the price action itself. Edges, this chart is displaying at least one of the chart edges we described in chapter 3 of the book and in the Edges and Setups webinar. Relative strength, the stock is displaying unusual strength, outperformance, momentum, and trend. And lastly, setup, the stock is forming an actionable setup because, again, if it's not forming an actionable setup, then all of this is void and it's not ready to be entered because you don't have a process to manage risk tightly and logically. Again, here's just a quick overview. This is covering the key points from the stock selection webinar. The two types of stocks we trade are either liquid leaders or performance enhancers. Liquid leaders can still make great moves, but they're going to be higher dollar volume, a little bit more higher quality, institutional grade, while performance enhancers are ones that can really make moves, but they're more operating based on a story or, just much faster and great reward, but potentially bigger drawdowns and bigger drops as well. And one thing to think about as you're writing your stock selection rules is how much of each type of these stocks are you going to be focused on? If you have 5 slots in your portfolio, are you going to dedicate 4 to 5 to liquid leaders and maybe 1 to performance enhancers? Or are you more split even 50-50? Swing traders might favor this type of name more because they're holding for shorter periods. They're really just playing those momentum moves, while position traders are going to favor a lot more the liquid leaders and names that can make longer term duration moves and still make exceptional moves, but maybe not, gain 30% in 3 days or something like that swing traders would be, preferring. So think about that as you're writing your stock selection rules and position sizing rules as well. Are you going to be focused more on liquid leaders or performance enhancers? I personally focus about 4 out of 5 of my slots on liquid leaders, and then split that last slot between 1 or 2 performance enhancers. But I'm kind of gradually trying to incorporate a little bit more performance enhancers. So I might go more 3 out of 5 liquid leaders and 2 out of 5 performance enhancers. Right. Anything you want to add in terms of stock selection rules that you like to incorporate? Just ways of thinking about writing rules about stock selection and finding the best stocks.
Yeah, it all depends on your time frame and the type of trading that you want to do and the risk appetite and the goals that you have in the market. So, for example, if a goal I have in the market is to rapidly grow my account, and then I end up purchasing, let's say, Bank of America stock, that doesn't really align, right, with what my objectives are in the market. So, the way I do it is I pick, 1 to 2 stocks that I feel will lead or be one of the leaders in the next uptrend. There's a question in the chat there is, what is a leader? I don't really know how to define one. It's basically a stock that's leading a theme in the market, and that theme is what's caused, is part of a strong uptrend in the markets as well. For example, if we take the AI theme, the semis theme, or if the solar starts leading over the next couple of weeks here, then that becomes a theme. And then what is the top name within that theme? That becomes a market leader because the uptrend is caused by multiple themes in the markets going or trending up upwards as well. So that's what a leader is. So what I tend to do is find 1 or 2 that I feel will do really, really well. So for example, you could take a Hood, a PLTR, a Netflix in this particular market cycle. Those are the ones that have moved first. Those are the ones that have moved the fastest and out of, and have shown the most relative strength. So those could be your first 2 or 3 names that you put into your portfolio. Now, the secondary names are basically stocks that have lower floats, higher ADRs that are moving, and you could surround your liquid leaders, the PLTR, Netflix, and these other names. We lost your presentation, by the way.
Yeah, I'm joining.
And we could surround those names with performance enhancers. So performance enhancers or performance boosters, whatever name you want to use, are basically stocks that are part of themes, still part of major themes that are leading the markets higher, but they move a lot faster. So you could lower your position size on them, but get the same results. For example, if you pull up PONY on your guys' end recently, that stock's moved from $7.50 to $18 since April 22. And that's a 100%, 120% move in a short span of time. That's a performance booster. It's part of the AI theme, right? Another stock that's done quite well recently is TEM. It's moved from the 40s to the 60s up the right side since April 22. So these type of stocks are what you can classify as fast movers. You can lower your position size on them, and that's what I do. I surround my liquid leadership stocks with these performance boosters. And the reason to do that, or the framework, and the reason I'm doing that, is to essentially hold my liquid leader stocks like the PLTRs, the Netflix, the Hoods, etc. So I can, when the market pulls back, I don't have to completely sell out of them. I can look and stay, look at the 21-day rising, and when they pull back in, use that opportunity to add more to them. So performance enhancer is kind of short-term trades that you're doing that significantly increase your equity curve and have them point in the right direction. They're building significant cushions for you so that when that eventual pullback comes in, when the Netflixes and the PLTRs pull back in, you could kind of sit back and assess the situation based on that, and you sell out of the performance enhancers. And then you repeat that cycle again and again so that your equity curve trends the right way. You're holding the stocks that you pick as leaders for multiple market cycles, hopefully, and then that's kind of how I go about it. So,
yeah, excellent. All right. So getting into components of a trading routine, again, we talked about this at length in the previous webinar. We're just talking about a high level. You want to outline how you're going to be doing market analysis, stay in tune with that, portfolio and post analysis, screening, what screens are you going to run, outline that in your rules, what lists are you going to maintain, how are you going to create your game plan. That's all what you want to include in this part of your rules. Here's an example of Rise Weekend Routine. Again, you could outline something similar in your rule set about how you're going to go from your screens, reviewing all the different stocks, reviewing the index ETFs, reviewing your portfolio, how you're acting, how you're all going from there all the way to finding new ideas, going from 100 names to 50 names to 4 names to actually be prepared for the next day, the next week. Here are some example lists to maintain. This could be a process that you adopt. Think about it as a funnel. You start with a universal list of about 100 stocks. You could update this weekly. It should be comprised of the current market leaders and stocks that are showing promise and setting up for the next week, ideally in the leading themes. Focus on software. Software is leading all of that. Then your leadership list should be about 15 stocks, depending on how wide the leaders are. And you can update this weekly, made up the top tier stocks that represent leading themes of the market. Maybe they're all already trending and away from proper buy points. You still want to incorporate them on the list so you're ready and reviewing them regularly to find setups if they do set up a pullback buy or the next base as they go. Then from there, you should have your weekly list around 10 stocks, updated weekly and can be updated daily with daily screening, made up of the strongest buy candidates for that week. And if a leadership stock is set up, it should be on this weekly list. And you want to prioritize names that have the most mature setups, have the most edges, and or are part of the leading / strongest developing themes in the market. And then from there, the last bit of the funnel is to have a daily focus list of around 4 stocks max, updated daily, made up of the best buy candidates from this weekly list that are ready to go the next day. They've got an inside day, they've got an upside reversal, they're right near the pivot, they're basically primed to break out and make a nice move for us the next day. So these are some example lists to maintain, but you want to find for yourself in your rules what lists you're going to maintain, how are you going to maintain them, what screens feed them, what's your process for going from a weekly list to a daily focus list, and all of that. Again, if you don't like the system, you can develop something else, but this is kind of an example and pretty much what I do when I'm organizing my ideas and my screens. Here's an example weekly routine. We won't go too in depth here, but you can incorporate this and apply it to how you like to trade. Here I have reviewed the DVU leaders screen by 1 month absolute strength, go from highest to lowest, have the industry data point visible so I can see what themes are standing out and all of them are moving up or breaking down. And then I spacebar through, add relevant ones to my universe list, and then go from my universe list to my weekly list, and then from my weekly list to my daily focus list. Here's an example daily routine pre-market. Again, the focus of the previous webinar was on routines. So go back there if you really want to get into the nitty gritty. These are just examples of how you can define this in your own trading rule set. Here's example daily routine for pre-market. Review the overnight action of the market indexes and key leaders. Identify if there are any changes in trend. Review existing positions. Make game plans if position management is likely needed, and adjust stops if need be. Then you want to review your daily focus list and make any adjustments, add one, take one out if needed based on pre-market action. Plan out your entry criteria, position sizing, and risk management for each stock on your daily focus list. Set alerts on positions and daily focus list stocks, as well as any other stocks you want to keep tabs on throughout the day. I like setting stuff at the pivot, just below the pivot, at the high and low of the previous day. Make a note about your plan for the day and situational awareness. Game plan for how you will act if this turns into a risk management day, and consider where we are in the market cycle and is it likely a day to increase exposure, do nothing, or play defense. And then take a moment. I think this is important before the market opens to relax your mind. This could be taking a walk, petting your dog, playing some chess if that helps you, and just kind of get your mind right for the session. So that's an example daily routine that you want to outline in your rules. Here's an example for during reviewing the price action, determine if it's a day to increase exposure. You will pretty much know that in the first few minutes of the day. Do nothing or play defense. Monitor alerts, positions, and your daily focus list. If it is a day to increase exposure and a stock triggers a setup and entry tactic, go ahead and enter and then place a stop loss order. And then this is kind of personal to me. In the last hour, it's kind of decision time. I review open positions and cushions and determine if I want to take anything off based on the cushion that I have. Then here's an example for post-market. analyzing QQQ to determine market analysis, go through positions, jot down any quick notes about my actions from the day or how they're performing, and then go through the process of screening for new ideas again, updating my universe list, updating my weekly list, and then identifying the likely top names for my daily focus list the next day. So that's an example daily routine for the post market. So that's kind of covers routines and how you can write rules for your routine. You want to basically outline what screens you're going to go through, what index ETFs you're going to review, basically everything you're going to do as a part of your daily or weekly routine to get you ready for the next day or the next week. Right. Anything you want to add about rules associated for routines? How traders can define those for themselves as they're writing their rules.
When to run them, what to run. Have a list of scans that you're going to run and execute after the market close, on the weekends, Friday night, Saturday morning. Knowing when you're doing all of that is as equally as important when it comes to routines. It's all about building a habit at the end of the day. The more habitual that you get, the easier it will be for you to run through the paces, get the information that you need, and prepare for the next session accordingly. But also, once you prepare for that next session, if you have a good day in the markets, you have a bad day in the markets, you'll know how to improve, and that feedback loop will kick in mentally, also in your results, and you'll get to compare. Hey, when I'm doing my weekend routine, I tend to perform a little bit better and make better decisions. Well, then it may be a good idea to have a weekend routine, right? Or my daily routine is a little too much. I'm spending 3 to 4 hours just researching, but it's not really impacting my results. Then you need to tone it back a little bit as well. So just, I think knowing when you're going to do that. So for me is 1 hour, half hour to 1 hour before the market closes to 1 hour after the market closes. You can get, things done out the way. You're ready for the next session, and then you're taking about, 12 hours off until the market opens again, right? The same thing for weekend routines. We spoke about, taking your Sundays off because, mental capital is also important. Well, making that a rule as well that, hey, I have to get my stuff done Saturday so I could step away because that's, how I perform best when the market opens on Monday. So those type of tactical, lifestyle-based and things also matter, and they should also be part of your business plan.
Yep, perfect. All right, so getting into edges, setups, and entry tactics and how you should write rules around them. Basically, you want to list out and define each setup and edge and entry tactic that you use, whether that's base breakouts, pullbacks, gappers, whatever you personally like to trade. You want to include annotated chart examples of valid setups to reinforce that pattern recognition, and that can be a resource for you. All the top traders talk about studying history, studying the past, studying previous market leaders, building a database of setups that they can refer back to, or just use them to train your eye to improve your pattern recognition. And then again, you want to be as specific as possible about the criteria that defines what does a base breakout look like, or what does a setup for a base breakout look like, what does the entry tactic you use exactly look like. Be very specific about the entry and all of that. Here's a list of edges that would be included in my trading rule set. The stock's in an RS phase. It's showing RS, a strong RS rating of over 90, either on a 1 month or 3 month basis. Significant growth in earnings or sales growth the last quarter, over 50%. It's part of a leading theme. It's got the N factor edge. We talked about this in the edges webinar itself. Trendability. This is something I look for. I look back when a stock is set up and interesting to me, and this is part of about how I find, that last layer, how I go from choosing a stock that's going to be on my weekly list or daily focus list, is I go back in time and say, has this stock been able to perform in the past? Has it been able to make trends like I want to see, going forward from the setup? Is it actually able to trend? That's what I'm looking for here with trendability. Then the HV edges. This is what Rye would include in his rules, defining what an HV edge is, including examples of HV edges. Increases in average volume. Daily 20 MA of volume or dollar volume increased over 25% over the past month. That's being very specific there. A price new 52-week high in the last month. Looking for that. A recent IPO within the last 3 years. All these are examples of edges that you want to list out if they're part of your process, to basically include in your trading rule set to make sure you've got them defined and thought through yourself as you go through, trading and doing your routines. So defining your setups again. Define what a setup looks like. A gapper could be defined as a gap up 5% or more on a news catalyst, but maybe you want to define that it's been in a base first. Again, that tweak is going to be up to you. For a base breakout, you could define that as a consolidation 20 days below a high, or maybe you like to look at a weekly chart to define it. Again, make it your own. And then a launch pad could be a cluster of 65 EMA, 21 EMA, and 10 EMA, all within 5% of each other. Again, you want to be specific there. So again, for each of your setups, for each of your edges, for each of your entry tactics, define what it looks like so that I could give that criteria to Rye and he could go out and find examples of a gapper setup. That's how specific you want to be as you're writing these rules. Entry tactics, same thing. Give examples, define the pattern, and define what your entry and logical and tight stop loss will be for each of those entry tactics as well. Right, anything you want to add about rules regarding the setups, edges, or entry tactics? Anything you want to add for that section?
No, I think like definition of those, more depth to that is making a playbook. So when I say relative strength phase, I've posted like hundreds of examples on my X feed, for example, using that as a journaling mechanism. Or if I'm looking at, if you're looking into fundamentals, then finding examples of that, screenshotting them, having them somewhere. Social media is kind of a great tool to just document, continuously put stuff out. And that's how I tend to use it. But you could also use an evergreen Evergreen, Notion, OneNote, and things of that nature to document. So it's important to have, we said an edge is something visual, great. You can see it on the charts every day, or when something happens with the HV. But then the execution comes from how we engage with a gapper, what we do to then purchase, make that entry tactic work for us. How many examples of the HV edge do we have documented, or once we document things, cemented into our brain? And then it becomes really, really easy to execute. The more documenting that you do, the more certainty that you have. Hey, here's how I can engage. The market environment's good. The market cycle is good. The way things are looking on this chart, the company, the environment, etc., all are checking out. It will become easier for you to then execute upon that framework as well. And that's where this webinar is very important, because it ties concepts into the actual rules where you can make a purchase in the markets.
Yeah, and what you just said there is something I've been thinking about the past few weeks about. I've been studying chess a little bit and kind of what sets apart the top chess players from normal people. And there's studies done where actually, if they're put in a situation that they haven't seen before, they're actually not too much faster at interpreting and finding the proper solution. But what sets them apart is that they've studied and stored away in their minds thousands and thousands of chess games and patterns and tactics and all of that. So when they see a game or participate in a game, it's just about recall to those games they've already studied. They're not trying to make decisions completely on the fly. They're using their studies and leaning on that knowledge and just recalling that knowledge that's directly available in order to implement and play the best move. So I think that's really important when it comes to trading as well. As Rai said, studying all these examples, having a library of what an RS phase looks like, of what a proper base breakout looks like, so you could recognize in real time those patterns, those successful patterns that have led to strong performance over the past. And then in the moment, it's less about making decisions completely from scratch. It's about recalling previous situations that led to powerful moves and just acting and executing based on that knowledge you've studied. So hopefully that made sense, but I think that's a really key point there. So again, defining all those setups, entry tactics, edges, really important. Getting into the next section, risk management. Basically, you want to define how you'll set stop losses for each setup, set position sizes as well, set maximum total exposure and maximum position size numbers as well, and how it changes based on market conditions. Write rules for when and if you'll use margin and to what degree. And then again, like I said, set default and maximum position sizes. For instance, 10% could be your starter size, and then max could be 20% in a name that you've got strong conviction in, has a lot of edges that you're checking off there. And then also you want to define when and how to pyramid in positions, if at all. Here's an example of what you can do, for a breakout setup, defining where your stop loss would be, place a stop 0.05% below the low of the day, pullbacks again, similarly below the range low or key moving average or key level, and then gapper 0.05% below the low of the day, if entering on day one, if you're entering early in the session. So you basically want to define for yourself, for your entry tactics, for your setups, where you're placing your stop loss. That's what's key with the risk management section. Here's some more. Standard position sizing is 10% of the portfolio. Maximum is 20%. For each edge in the stock, you can add 2.5% of your portfolio to allocate to that position. And during downtrends, maximum position size is shortened to 15%, and your starter size instead of 10% is 5%. And then here's some portfolio drawdown, some circuit breaker rules that you can incorporate. At a 5% total drawdown, have position sizes, sell weakest positions. At 10%, no new buys, raise stops to existing positions, on existing positions, and then 50% go to cash. So those are a few risk management things you want to think through, basically defining your stop losses, defining your position sizing, and then any kind of portfolio level drawdown rules that you want to incorporate. Right, anything you want to add on writing risk management or stop loss rules or anything related to that?
Yeah, have a max stop loss rule. So if a stock, after your purchase draws down 3 to 4% or 5 to 7%, we spoke about the math in the first few webinars there, right? So have that. I think that's important. The other one that I use in my trading is the equity curve pulling back off highs more than 5%, 5 to 7% is a red flag. It's stopping yourself from yourself because you're placing trades, but the market's saying now is not the time to place trades. Another one for me is if I've had multiple losses in a row, the first position that I take won't be 25%. It will likely be 7.5 to 10% range, so I can get my confidence back. So there's we're not sitting here posing as we never have drawdowns. There's no losses for us because we have this system. There will be losses and there will be times you're not confident in the system that you are executing upon, but having those rules allows you to avoid significant drawdowns because the longer you survive, the better you will be and the better you'll execute, and it will be much easier to make money in the market. So that's another one that I have. Another thing that I look at is when the market goes into a parabolic run and where everything's working, like just anything and everything's working, making sure that the performance boosters have a clear plan on, if something's moved, like move from 7.5 to 18, I'll just sell it for no reason at that point because I know that the reality of the market is that these type of things happen once in a while, not every day. And if that thing moves from 18 to 50, I'm okay with it. It'll likely give me another entry area. So some way to cap my, euphoria, thinking that the name that I just got is the best name ever, kind of curbing that somehow. So I have a few things there where if a stock moves, 100% in 7 or 8 days, it's a good, trade. You made a good trade. It's not going to basically happen again and again. And I've learned my lesson where I hold those things a little too long and give back a lot of, that all comes from learning. So these are just additional rules to, cap euphoria as well, because you get kind of crazy and you think that, now this name that nobody's ever heard of, Pony AI, is now the best AI company in the world, right? So that can happen, especially when you see all that money come through in your P&L. I'm just trying to think what else in terms of like rules that I use that could help everybody out. Taking days off is another one. Once in a while, I think vacations are important. Yes, the market's open 24/7. It's going to be open 24/7 by the February next year. So, just because the casino's open doesn't mean that you just have to trade. And that's about it. If I have any others, I'll definitely share, Richard.
Yeah, cool. Yeah, so that's excellent. So getting into more sell rules and position management. Again, we had a whole webinar on this. It's just from a high level, how you take that knowledge and put it into rules. So you basically want to define for yourself, what are your sell rules? Are you going to sell primarily into strength? Are you going to sell primarily into weakness? Outline how you're going to manage winning trades, raise stops, trail, scale out, etc. Clarify, how you'll let a stock work and trend for you, and then when you'll ultimately exit based on a violation and rules to sell into weakness. Also, like Rye mentioned, create rules for handling gaps, fast moves, or parabolic runs. These type of things, especially if you're a new trader, can catch you off guard. And it's great when a stock gaps up 20%, but what if it then pulls back 10%? Into the end of the day, that hurts if you haven't experienced that before. So you want to define for yourself how you're going to handle those situations, so you're ready and know and just following your script as you go. Then, I think this is really important as well. Practice your sell rules on real examples going back in the past. Say you entered here on this model book base of NVIDIA. Where would your sell rules have gotten you out? And is that where you want to get out? Or do you want to really focus on capturing more of the trend until it really ends? So again, there's a trade-off between selling into strength and selling into weakness. And you have to define for yourself where that balance is about keeping a position on longer versus just, locking in profits and moving on to the next name. And again, we did a whole webinar on this. So here's some example. This is an example system that you could use. Sell a quarter of the position if you're up 10%, or your average gain, or you're at your average gain over the last 20 trades. Sell another quarter on an extension of 20% or more from the 20 EMA, or at a key reversal bar, and then sell your last half on 2 closes below the 21 EMA. These would be sell rules into strength, and this would be your sell rule into weakness. And then you could also add, if you'd like to, add another buy point. And I talked about different variations in sell rule systems in that webinar that I think you definitely should review. Here are some earnings rules. If you're a position trader, you're going to want to hold through earnings at some point to catch the big move. But how do you define if you can hold through, or if you should even hold through? So here's some example rules. If up less than an implied move, sell the position. If up greater than an implied move but less than 2x, sell half or more. And then if up greater than 2x implied the move, you can stomach a gap down 1.5x the implied move, you can hold through. So you kind of want to define for yourself when you're allowed to hold your position through and how much of your position as well. Right, anything you want to add on sell rules and position management? Again, definitely revisit the whole webinar we did on this topic. We really get into the details there with some concrete rules that you could use. But yeah, right, anything you want to add here? You're on mute, I think.
There we go. Am I good now?
Yeah, you're good.
Yeah, I think the only one that I would add is, through experience, rules they kind of get cemented in the back of your head, and writing them out, I would say, after a decade or so, maybe is a little less important. But the market reminds you that it's quite important, especially when your things are pulling back and you're struggling, and you kind of go back to the basics of it. So some traders are at super amazing at writing them down once and never breaking them. Some traders need them to be printed and placed on their desk, or sticky notes, or something on their wall, something on their phone. I've seen iPhone wallpapers with rules and things of that nature. So it all depends on what works best for you. If you're a visual person and you need to see that as a thing, as a sticky note on your desk, then do that. But over the years, what I've learned so far, trading the markets, is that the rule set is important. You have to go back and update it, and the more that you get away from that habit, maybe at every 3 months, 6 months, just looking at it, revising it, fine tuning it, the more you get away from that, the performance takes a hit, no matter how experienced you are. Because what happens is the market will get you in that state where you think you're invincible and you're crazy good and nothing can stop you from anything. But it's the rule set that will then get you back on track, especially when you're struggling. So find a way, whichever way you get it printed, have sticky notes, put it on your iPhone wallpapers, have it written out in a notebook that you carry around, whatever the case might be. But I think those things make a meaningful difference, as even though they might sound really corny and very something that you guys may not be doing at the moment, I think the visual aspect of it and writing them out by hand, it has been the most effective for me, and also having sticky notes, etc. as well. So
Cool. All right. Perfect. So getting into post analysis and journaling, again, you kind of want to define in your rules how often you're going to do that. And the most important thing is to be consistent. If you're not able to do it daily or weekly, just set a cadence that that you'll be able to stick to. The it's not going to help you if you're going to be inconsistent. You want to be consistent above all else. So you don't want to say you're going to do it daily and make that promise yourself, and then you forget about it, you fall out of the habit. You basically want to set a cadence that you can do. Maybe that's every month, that's every 3 months, whatever. Any post analysis is better than none, right? So also you want to create a consistent journaling habit to track your mindset, execution, and lessons. I personally do this daily. It really helps me break down the day. And I talk about what stocks I entered, if at all, that day. How are my existing positions doing? What's my percent gain in those positions? What is the market trend currently? And then I'll kind of give myself a grade each day about out of 10 about how I feel like I executed my plan for that day. And that really kind of keeps me on the right track there. So regularly plan in post analysis to, again, to have that feedback loop. Going back to the smoothie example, you want that feedback loop so you can improve over time. That's the goal. And without that and building it into your process, building it into your trading rules, it's not going to get done. So here's an example. Each month, import your data into a spreadsheet and calculate your batting average, average gain, average loss, average holding time for winners and losers, and then compare these metrics to your averages. Sort your trades by percent gain and review your top 5 trades of the period and top and worst 3 trades of the period, and then mark up your buys and sells for those trades on the chart. You'll learn so much just looking at your best and worst trades. Note down any key observations or takeaways, and then on a daily basis, like I said, you can jot down any notes or observations. Tracking themes, that's something I do in my daily journal as well. Your positions and profit cushion, any actions taken for that day. And then, it might be helpful to give yourself a quick grade, 1 to 10. Be kind to yourself, but, be objective and on how you feel like you executed your plan for that day. Right, anything you want to add on post analysis and journaling, things people should keep in mind as they get into writing rules around that?
what I do is every quarter, I take a look at what I did on a daily basis. It's just more of a portfolio check to see how things are going. If it's a significant drawdown day and you get caught, in a gap down like the DeepSeek semi situation that we had this year, or an individual stock that was looking fine on the charge, gaps down 20%. Those days I spend a little bit more time looking at, maybe I could have done something differently, or I would have just, done the same thing. It's just one of those things that the market tends to do to keep you in check. So depending on the situation, so there's, a daily aspect to it that's more mental and informal, but a more formal aspect is, IBKR sends out quarterly, monthly emails with all the trades that you've placed. So those are good and something that I look at. And also at the end of the year, looking at all of them and doing a holistic analysis. And then we also do a bunch of model books as well. So that serves as, a feedback loop where we do the model book, have it out to you guys. But for us, it's also part of a post trade analysis to see which leaders we caught, which leaders we missed, what we did from a trading aspect, what we could have done better to get in some of these names or position size a little bit better, etc. So for me, it's a daily is a bit more mental. If you have a significant drawdown, you do more. Quarterly is a bit more formal, and yearly for sure is something that has to be done so that you can then, kind of improve year on year as well.
Yeah, on a yearly basis, when I kind of build the yearly model book for myself, I think about what were the best opportunities of the year. Did I catch them? Did I trade them too early? Did I sell them too early? And that's a kind of good perspective to look back on the year and say, based on how I could have executed this year and the performance I could have had, how did I do? And you'll learn a lot from that process. Here's a quick example. Next weekend, I see somebody asking this question. We'll be completely dedicated to post analysis, both marking stuff up on a spreadsheet, setting all that up. We'll give a trade log that you can use, and we'll talk about actually how to grade, charts and mark buys and sells, all of that process. So I saw somebody asking about journaling tools. I personally use Google Spreadsheets right now. Google Sheets, and we'll be building a lot of useful stuff into DeepView that will make this whole process a lot easier. So that's what I currently use. So getting into contingency planning, this is kind of the last section of your rules. This is a little bit more, any rules that you haven't put in before is kind of more general or maybe more specific. You can put in here. Plan for worst case scenarios, massive gap downs, tech issues, account lockouts, how you'll have backup systems, how you'll access your brokerage if your computer dies on you, you lose internet, all of this, where you'll store logins to your brokers, emergency checklists if something horrible happens. Basically have a panic playbook, I put in quotes here, for key things that might happen and will happen over the course of your career, but that you definitely want to plan for. Here's some examples. If you lose power or internet, my plan is to log into my broker on my phone or head over to the local coffee shop. I've got many in my neighborhood right there with internet. If there's a large gap down, if it's a game-changing catalyst and down more 25% of the position, exit in after hours. You have to define for yourself, I guess, what's right for you. If you're locked out of accounts, I always have stops in, hard stops with my broker, worst case stops. And then I also have the number handy of my broker so I can call them and get that issue sorted as soon as possible. And then I think this is a big one, travel/life disruption. If you have a death in family, if you're, traveling across country, stuff happens. If you have a kid, like with Rye recently, you want to kind of think about how you're going to handle those situations because it will impact your trading. Whatever's going on in your personal life is going to impact your trading. So think about whether you're going to exit positions altogether or keep your strongest ones that have great cushions and check in every day. Think about that in advance. This is really important for me going on vacations. I typically just sell out unless I've got a great cushion on it. And then, that allows me to actually relax and, get the benefit of the vacation right. So this is an important one that you should think through for yourself, how you're going to handle those type of situations. So that's kind of it for contingency planning. Right. Any other kind of key rules that you have for special situations that might happen when you're trading?
Yeah, I mean, I don't think the best positions, if you're away from the markets and your time frame is swing trading, it's just best to sell out is what I've seen. You don't want to have, if you're taking time off, half your brain in the markets, half your brain off the markets. It's usually what I found best is to just take time off. Market cycles happen for a reason, so corrections, are opportunities. And if you're taking a week or two off or three, is perfectly fine. The market is there. There's unlimited amount of opportunity that happens every single day. And it's not really a matter of, hey, if I sell a stock that I'm, currently in and I'll never get another entry on it. So that type of mindset maybe is more of a stage 1, 2 type of mindset. Stage 3 and 4, Oliver goes on a sailing trip every year for 2 weeks, completely offline, nothing at all, sells out of all his positions, is not, paranoid that the market will leave him behind. That's something that he does, but when he comes back, you can see the performance in his numbers, right? So there's a lesson in that, and a reason that many successful traders do that. So my thing would be, if you're stage 1, 2, don't, be overly just thinking that the market will leave you behind if you take a little bit of time off. That's perfectly fine.
Yep. So here's some kind of key summary to kind of wrap up today's webinar. Written rules, again, they're your business plan. They're your contract with yourself that you're serious about trading. They're required if you want to treat this like a business and not just like a hobby. Hobbies lose us money. Businesses make us money over time. And we want to be making money while we're trading. Post-analysis and journaling are essential to have that feedback loop to improve your rules over time. And this is really key here. Your rules are a living document. They're going to refine them as you grow, as your style shifts, as you gain a setup, lose a setup. And they'll probably need updating once you've got a standard set about every year. But, if you haven't written a set yet, my challenge for you this weekend is to dedicate a few hours. It doesn't take too long to follow the template that we're going to send out by email and make your first rule set or refine your rule set. If you haven't, updated it in a year or so, this is your sign to go ahead and update it this weekend as well. Again, this is your business plan. Treat it with the appropriate respect it deserves because it will help you in the long run and allow you to be consistent over the long run and perform over the long run. So again, this is our challenge. Our call to action for you guys is to go ahead and write your first trading rule set or update it, refine it, this weekend. And again, for each of the sections that we talked about today, go watch as you're working on your market analysis section, the market cycles webinar that we did. If you're talking about sell rules and position management, that needs the most work, go watch our webinar on that. That's kind of the whole purpose behind those webinars, is each of those thoroughly explains the concepts and how to apply them. And then this trading rule set webinar is about how to actually incorporate that into a trading rule set. So again, that's pretty much it for today's webinar. Another reminder, for only people who have ordered and pre-ordered the Trader's Handbook webinar and submitted your receipt, the link to that is in the description of the live stream today, and I'll send it out by email again. We'll be doing a special advanced trading breakouts webinar tomorrow, going through the full process from screening for them, to executing, to managing them as well, including how to trade gaps around pivots. I think that's something a lot of people are confused about, so I'll be covering that. And basically, to submit your receipt, you can scan this QR code. The link again is also in the description, but you can order it from anywhere. I saw people asking about Barnes & Noble. Just go ahead and screenshot that receipt, make sure the order number is clear there, and submit it in this, and you'll go ahead and get access to all these bonus webinars, as well as all the bonuses in the launch week itself. And I'll be sending out the link via email right after today's webinar today. So if you haven't received anything just yet, if you submitted your receipt, that's all you need to do. And I'll be in contact in the next really 30 minutes here after today's webinar to send out the link to this webinar. But again, this will be really good, and it's reserved only for people who have actually pre-ordered the Trader's Handbook. So definitely go ahead and order it today if you haven't already. And remember that this weekend as well, you'll get $100 in TraderLion gift card. So that's a nice bonus to go ahead and purchase your handbook today as well. And with that, I think again, here's the QR code to order the handbook itself, and we'll pause here for any key questions that you guys might have on writing rules. Let's see here. And yeah, tomorrow, for anybody who's ordered the Trader's Handbook, we'll be sending out the recording of tomorrow's session as well. And yeah, Kindle gets access. You just have to submit your receipt. All right. Right. Anything before we go to questions, anything you want to really emphasize based on writing trading rules, or to summarize today's presentation?
I think there's no right way to do it. The most important is to just maybe write down a list of 5 or 10, and then as you go and as you trade, if you don't have a rule set, list will kind of build out over a span of time. But then you can start to segment it into position sizing rules, market cycle rules. How do you track leadership, and how you determine leadership, right? A process for that. And then that segmentation will come naturally because those are slotted into different, ways of you to then put together a full system as well. So no right way, just write out. I've seen people write out, a list of 20 rules that, Webster has a list out there on his X. So there's no I would say template. It's just you make it, and then you will see segmentation that becomes really, really clear.
Yeah. Something is better than nothing, right? Yeah. So start small. I saw a really good question from Tom. How to have confidence in your trading rules. I think you gain confidence through experience and applying them consistently through different market cycles, and then you can always tweak. But I gain confidence in mine through experience and knowing that a stock trending above the 21 EMA is doing nothing wrong until it breaks below that, and that will keep me in that trend from base to base. So yeah, I think you gain confidence through experience. Let's see, any other questions here today? Let's see. If I order the book on the first webinar, I will have access to tomorrow's webinar. Yep. If you submit your receipt through that form, I emailed it out to folks. So make sure you submit your receipt there, and then you'll get access. I'll be sending out the email to people who have pre-ordered with the link to the breakout webinar. But again, you have to submit your receipt to receive that email through this QR code. The link is also in the stream description. All right. Yeah, I think the Barnes & Noble sale that was only for a limited time. There is actually an extra sale on Amazon right now, I saw. Ali, it's just for one book. but you get extra bonuses for ordering multiple. That's in the forum description as well. All right. Perfect. I think we can pretty much call it there. So again, thank you guys all for spending some of your Saturday with us. We definitely appreciate it. Hopefully some of you who answered B's and C's in the chat at the very beginning now have a concrete plan and way to organize their thoughts and rules. And again, our call to action is to actually go ahead and update your trading rule set this weekend. So thank you guys all for tuning in. Hopefully you guys are finding these webinars really valuable. I have a lot of fun doing them. I know Rye does as well. And they complement the book really nicely. And, you know, our goal is to make a great trading resource for people in the beginning stages of, you know, their trading journey and hopefully accelerate their learning curves. And I think we're accomplishing that. So again, thank you guys so much for tuning in. And hopefully I'll see you all pretty much tomorrow at the Breakouts webinar. Just go ahead and submit your info through that extra form. I'll email that out later on as well. But thanks again. And we'll see you guys in future videos. Take care. Bye.